everyone, it's Kathy Lean here with BK Traders. We finally made it to the last trading month of the year, and what a year it really has been. While many people are thinking about the holidays, presents, and family celebrations, we still have a few more weeks of trading to go before we can close the books for the year. And these last few weeks are going to be important ones. In this video, I will share with you some of the main factors driving the markets in the month of December, what to watch, and how these events could affect the markets and your trades in the new year. But before we get into that, if you really want to know about the best opportunities in trades, we're actually going to do a 2024 market preview this week, and we'll share the juiciest trades and the biggest risks for the new year. The link to register for the event is in the description below. And if you're watching this after the event, I'll replace it with the replay. Now, let's start by talking about the month of November. Last month, I prepared you for the big bull market that we had. If you watched my November market outlook video, I showed you this seasonality chart. And in this seasonality chart, I talked about how November is historically one of the strongest months of the year for stocks. But I have to admit, I did not expect the second strongest November performance for stocks since 1980. Stocks hit a year-to-date high, and 10-year Treasury yields in November backed off 16-year highs. Of course, all of this is related. Treasury yields peaked in October and nosedived in November because of lower yields or interest rates, which is actually good for stocks, and that's why stocks rallied so much. Lower yields was also bearish for the US dollar, which sold off sharply in November. I hope you're learning from my videos that these markets are all related and they impact each other, because the sell-off in the US dollar also is the reason why we had a strong rally in gold in November. Now, December is also traditionally a good month for stocks. In fact, according to the numbers, on average, December is hands down the strongest month for the S&P 500 in the last 20 years. Now, I don't think you can expect a match in this year's performance because November's was already such a good month. Any material gains in stocks that we see in December will probably happen in the second half of the month due to the Santa Claus rally period. This usually begins on December 22nd and can extend as long as January 3rd. The S&P 500 has historically generated strong returns during the 7-day period, so watch for this opportunity at the end of the year. Meanwhile, the main focus for everyone from central banks to investors and traders will be on inflation and interest rates. Across the globe, inflationary pressures have eased sharply this year. Here in the US, the year-over-year CPI rate is now 3.2%, half of what it was back in January, the start of the year. Many of you may have already forgotten that in 2022, the CPI rate was as high as 9.1%, 3 times the current levels. There are a number of important central bank monetary policy announcements before the end of the year, many of which are actually happening this week. In fact, this is probably the busiest week in December for the financial markets, with 4 central bank meetings on the calendar: the Federal Reserve meeting, European Central Bank meeting, the Bank of England meeting, and the Swiss National Bank meeting. Now, none of these central banks are expected to change interest rates, but we don't need a rate hike for a big move in the currency, right? You should all know that by now if you've been watching my video and following my channel. On top of that, the U.S. also will be releasing its latest inflation and consumer spending, or the retail sales report. Now, the Federal Reserve has been divided on the need for more interest rate hikes. Fed Chairman Jay Powell wants the market to know that it is still a possibility. The option is still on the table and could still happen. But one of the most hawkish members of the Fed, Christopher Waller, has moved away from the idea of another interest rate hike. So what it all comes down to is economic data. We already know that the U.S. job growth was strong in the month of November, reinforcing Powell's hawkishness. Non-farm payrolls was much stronger than expected, with a sizable drop also in the unemployment rate and a rise in the average hourly earnings, which is exactly what you want to see when you want to look for a strong labor market. Now this week, this December U.S. inflation report will actually be released before the Federal Reserve meeting. So that could play a very big role in setting expectations for the Fed. All of this, including the retail sales report, could go a long way in shaping positions for the financial markets and the US dollar in the new trading year. So it'll be very important to watch. But the key event will, of course, be the Federal Reserve meeting, because the Fed will also be updating their latest economic projections and the dot plot, which shows how policymakers think rates will move next year. Investors and traders will be looking to see how many members favor a rate hike, how many see a first quarter or first half interest rate cut. Investors and traders will also interpret any major changes in the economic projections for growth, inflation, unemployment as a reflection of the central bank's 2024 guidance. No changes in interest rates are expected from the European Central Bank either, but like the Fed, they will also be releasing their latest staff forecasts or economic projections. Bets for an early rate hike next year by the ECB are growing, and the ECB is widely expected to be one of the first major central banks to lower interest rates. So if the ECB cuts their growth and inflation forecast, we could see another sharp sell-off in the euro. The Bank of England won't do much. They'll probably just warn of more risks ahead, while the Swiss National Bank won't be happy with the recent surge in the Swiss franc. If you check the charts, the Swissy is trading at its highest level in 8 years versus the euro. The Swiss National Bank could also talk down the currency, which, however, I think is less likely than expressing their concerns about growth. Last but certainly not least, employment reports are due from the UK and Australia. PMI reports are due from both of these countries, along with the Eurozone. Now, I personally watch PMIs very closely because they're the first pieces of economic data released for the month of December and can give us significant insight into how the rest of the economy is doing and how the rest of the economic reports for the month could fare. In a nutshell, there's a lot going on. If you want to know more about the best opportunities and trades, we're doing a 2024 market preview this week where we'll share the juiciest trades and the biggest risks for the new year. The link is in the description below, and if you're watching this after the live event, I'll replace it with the replay. I hope you enjoy this video, and I hope you have a great week.